Good morning and welcome to this Wednesday, April 6th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got another rough start to the day ahead, it appears. Futures are down pretty significantly. We've got the 10-year Treasury yield continuing to roll to the upside. Yesterday was up about 15 basis points. Today it's up another 8 basis points, 2.63%. Just a couple of days ago, I was talking about the yield range being in the 225 to 250 area. Well, we can scrap that. We went right through 250. So it certainly looks like we're heading now toward that 3% level. Wasn't that long ago we were fighting to get toward the 2% level. So definitely moving along pretty quickly. Historically, I would still say interest rates at that level are not a concern. However, anytime you have interest rates going up rapidly, it's a concern because it's going to have an effect on the economy. And, I've said all along, I thought the next shoe to drop was going to be the recession, perceived recession. And I think that's probably what we're going to be hearing more and more about as interest rates keep climbing. Right now futures down quite a bit. Got the Dow futures down 250 points, S&P 500 futures down close to 45, NASDAQ futures over 230 down. So across the board, not good. The NASDAQ, which had a really good day back on Monday, had a poor day yesterday on a relative basis. And it looks like today going to start off on a rather poor note. It's down on a percentage basis, almost 1.6%, whereas the S&P is down less than 1%, and the Dow down around 0.75%. So that movement back out of the NASDAQ that started yesterday continues this morning. I will say, though, when I look at these uptrends and downtrends, one of the things I like to do, and I guess maybe it's the former practicing CPA in me, but I always like to put on a spreadsheet and just track how much of the moves to the upside or the downside are orchestrated, are gaps, and how much are really trading throughout the day. And that can make a big difference as to, what we think about the stock market, or how, is it truly distribution, or is it just gap down, forcing folks to panic, where we have Wall Street stepping in, and jumping in, picking up shares of others. Yesterday was purely a distribution day. I mean, it opened down a little bit, but not much. I mean, we opened on the QQQ yesterday at 367.81, and we finished at 361.10. So there was $6.70 of down action in the QQQ during the day. Now, today we're getting a big gap down. It's going to be interesting to see, do we, rally off the gap down? Is it a temporary rally where we gap down in the morning, we gap down early, come back in the morning a little bit, and then sell off into the afternoon? That would not be a good look. So there are a lot of different ways to approach this, but it just seems like, and I wrote about this a couple of days ago, or maybe talked about it, I can't recall, but the aggressive groups, once again, were leading at the top, as we were making the big move to the upside, the last big move to the upside. And that's a problem. Yesterday, we saw the aggressive groups getting hit pretty hard to the downside. And there were 4 groups up, and we're going to talk about that in just a minute, but they were all the defensive, of the defensive variety. Anyhow, going to get into a lot of stuff today. It's going to be a pretty interesting day in the market for sure. But let me take you over to Earnings Beats. For those of you that are new to Earnings Beats, if you go over to earningsbeats.com, scroll down, love to have you as part of our Earnings Beats Digest community. This is our free newsletter, no credit card required. You can unsubscribe at any time. Comes out 3 times a week, Mondays, Wednesdays, and Fridays. Just simply type in your name, email address, hit the subscribe button. This has been a pretty good week to be a community member, because I have provided a couple of short squeeze stocks, one on Monday, one this morning. The one this morning is GoGo, and that one could be very interesting because after the close yesterday, they were added to the S&P Small Cap 600. Stocks up about 10% in pre-market today, which takes it back to about a June 2015 high. We haven't been at this level in almost 7 years. So anybody who's on board shorting, and this stock's got about 39% short percentage of float. That's a high number. So I can't imagine, but I'm sitting there. If I'm sitting there and I've got a decent sized short position and I see the stock being added to the S&P 600 small cap index up 10% pre-market at a 7-year high, do I really want to, put my foot down and short some more, or do I want to just let it go and buy? And if I buy and other shorts do the same thing, obviously go is one of those stocks that could really go. There's no guarantees. Maybe there will be some shorts out there that'll continue to, just keep stepping in front of the freight train, and maybe that'll be enough to slow it down. But I just wanted to mention, anyway, that's one of the companies that we reported this morning in the EB Digest. And also anyone on the EB Digest was able to get a link and password to our short squeeze chart list, which features 39 of the most heavily shorted stocks right now. In addition to giving you the stocks, we also give you the short percentage of float, and a pretty nice little free gift. We do that every, once in a while in our Earnings Beats Digest. So there's a number of reasons to join in. Also, sometimes we do our free events, or when we do our free events, we reach out to the entire Earnings Beats Digest community with a link to the room. So we're always including that community in any of the free events we have. And we'll have some of those coming up, by the way, over the next couple of weeks. Got a big ETF portfolio, or model ETF portfolio, coming out on the 19th of this month. So we'll have a sneak preview, show you a little bit of how we put that together. That'll be a free event coming up probably in about a week or so. Anyway, you want to make sure, if you're not already signed up, there are a lot of reasons to be an Earnings Beats Digest subscriber. All right, let's move on to the action from Tuesday. Dow Jones Industrial Average down 280 points, S&P 500 down 57, NASDAQ down 328. And on a percentage basis, you can see 2.25%. S&P was only 1.25%, and the Dow was only 0.8%. So you can see the weakness just a day after so much strength that we saw in the NASDAQ. That's the crazy volatility. That's the crazy rotation. That's just the crazy stock market that we have right now in 2022. Nothing seems to stick. This rally, which seemed like it was sticking for a while, and I did produce some really good signals, I think, for the more intermediate term. Whether or not we go down one more time has been something up for debate. At some point I would expect that we go back down. I've been talking about this maybe more in terms of consolidation rather than a full-fledged S&P 500 bear market. I don't know if to get the S&P down 20%, which is what everyone looks at to call it a bear market. I don't quite get that. It's been pretty bad. Call it whatever you want. But in order to get to 20%, the S&P would have to get down to 3,800. Based on what I'm seeing and what we've seen in this rally, I don't know that we get back down to 3,800. I mean, anything's possible. And obviously, if you break below 4,100, you're opening the potential floodgates. But I would expect that we're going to go back down somewhere in the 4,100 to 4,300 range. That's what I would be looking for. We'll just see how the market evolves, if that is the case and we do get back down into that area. Mid caps, small caps also had rough days, down 1.8% on mid caps, 2.25% on the small caps. So small cap and NASDAQ went hand in hand, both down 2.26%. We're seeing the AD line start to roll back over again, but just recently printed a new high. That's one of those bullish signals that I'm seeing in the market. I mean, the Dow well off its high, the S&P well off its high, the NASDAQ well off its high, and yet AD lines all went to new highs. So that's part of that, what I was talking about earlier when I was practicing as a CPA, doing a lot of spreadsheets, and I just love to analyze. And so when we see the AD lines going up, price action going down, a lot of that has to do with what I call manipulation, where you're getting a lot of movement to the downside coming with gaps, and then you actually see more buying throughout the day, which is accumulation. That's why your AD lines are going up, prices are going down. So that's something I want to really watch if we do have another leg down. How much of this is true distribution and how much of it is gap downs? If you recall, one of the biggest reasons anyway, that I remained bullish during the pandemic in March of 2020 was Most of the sell-off occurred at the open. If you're a member of Earnings Beats or you've been around me for the last couple of years, you remember I wrote about it, I talked about it a ton. I mean, I way too much probably, or maybe not enough. I don't know. But a lot of that move to the downside in the pandemic was everyone being so fearful and reading all the headlines, the nasty, awful headlines. Great Depression 2.0 was coming. You know, we'd never recover from this. This is going to be the worst thing in history. You know, worst thing since 1929 and blah, blah, blah. But when you looked at the AD lines, many of them, especially in the growth area, the AD lines were soaring because when the Dow and S&P were all opening down 3-4% in the mornings, the growth portion of the market was actually rallying during the rest of the day, and the value portion was going down. Well, it pays to continue to do that. And that's one of the things that I want to look at. If we do take another leg to the downside, that will be one part of my study is the market truly being distributed? Are we seeing that distribution throughout the day like we did yesterday? Or is it going to be more of what like we're seeing this morning, where we wake up to big bright red futures and then we have a little ups and downs? And if it does look like maybe there's some accumulation, which areas are being accumulated? Is it the growth area again? These are all signs that, you know, it's not just about trying to call the market bottom. It's about seeing the signs that help you call the market bottom. We've seen craziness back and forth. Trying to time the market, very, very difficult to do. I mean, you can use sentiment indicators to help a little bit. You can use these under the surface signals to help provide you some clues about maybe the intermediate term or longer term. But trying to time an actual bottom and top, really difficult. And that's kind of been on display throughout 2022. Within the sectors, yesterday, 4 sectors were higher. Care to guess which ones? Of course, it was a down day, so this isn't totally unusual. But utilities and healthcare were the 2 best performers yesterday. Real estate and staples also both up yesterday. Those were the 4 groups went higher, the defensive groups. To the downside, leadership, discretionary, down 2.34%, technology down 2.11%, energy down 1.57%. Those were your 3 leaders. But look at the 2 primary leaders. These were both aggressive areas of the market. So the 2 groups that had such big Mondays to the upside gave it back on Tuesday. Not exactly a great feeling, you know, looking at the way the market acted. 10-year Treasury yield yesterday, you can see was up. Well, actually, this is a weekly chart. I did this a little bit different. So far this week, let's get an update here and see where we are right now. 2.635. So we're at the high of the day. Just between yesterday and today, we are up 26 basis points on the 10-year Treasury yield. That would be a big week, and it's only Wednesday. So just the last 2, well, actually, I guess it's the culmination of Monday as well. But so far this week, we are up 26 basis points on the 10-year Treasury yield. And if you look since the beginning of March, we were down at the end of February, down around 170. We have gone up 90 basis points in just the last 4 or 5 weeks. That's a lot. And so it's not so much that yields are going up. It's the fact they're going up so rapidly. And that, I think, is going to be another sign or another signal that we could have an upcoming recession. Just because there's too much, well, we'll see how it impacts the banks. But right now, the banks are not performing well. So that's not a good sign. I talked about truckers last week not performing well. That another sign. I mean, why would truckers be falling apart? Well, one reason would be if you're going to ship less goods. The market sees a recession coming. Truckers do not fare well. Railroads generally don't fare well. Both of those, I mean, you're not going to truck something over to Europe. I mean, you ship it right here in the U.S. So when truckers are not doing well, railroads are not doing well, or if they start to roll over, those are signs that the domestic economy could be in trouble. Now, there could be more specific reasons for those areas going down, but by and large, when I see transportation stocks not doing well, that makes me think not really good things about our domestic economy, or at least consider the possibility that things are not going well for our economy, or that they won't go well. Market always looks ahead. It's not looking at last quarter's earnings anymore. It's looking at this quarter, next quarter, and probably the quarter after that. We're looking at the balance of 2022. And right now, the truckers are saying, don't really like what we see. Now, here's the good news. If we do have a recession, the stock market bottoms way ahead of the recession, or during the recession. It doesn't wait until the recession's over to start going higher. So even if we're heading into a recession, I think, number one, if we do have one, it'll be a very, very mild one. But if we have one, I would suspect we will probably have it over the next couple quarters, or maybe over, maybe 2 of the next 3. And the market likely would bottom, I would think, over the summer, probably a double bottom, or maybe even, maybe slightly take out the S&P low that we saw back in February. We'll see how this all develops. I mean, I'm talking way ahead right now, but just some of the signs are telling me recession. The fact that the rates are climbing so rapidly right now, that likely points us in that direction. I've talked a lot about consumer sentiment and the fact we have been dropping for over a year now in consumer sentiment. That's normally a very strong leading indicator of a recession. There are lots of signs. It's not just, saying, oh, well, truckers are going down or rates are going up, or it's a lot of things. And the sentiment is a big part of that as well. One thing I wanted to mention down here too is a lot of times I talk about rates going up for the right reasons, and sometimes rates going up for the wrong reasons. Rates going up for the right reasons would be a stronger economy ahead. The Fed sees things really picking up, and they want to just stay ahead of inflation, which isn't a problem at the time. It is a problem at this time. I'm talking about, in just historic terms. When the stock market is going up because of anticipated economic strength, usually the yields go up as well, because money rotates out of bonds and goes into stocks. And the money rotating out of bonds, when you're selling treasury, sends the yields higher. So when the yields are going up and the stock market's going up, that's not bad. That's actually a normal thing in the market. But when yields are going up and the stock market is going down, and that's basically what we've been seeing here in 2022. Forget about March. Yeah, the last 2 weeks, yields have been going up and stock market went up. But look at what's been going on throughout the year. The last 4 or 5 months, when we've been having all of this problem, or all these problems in the market, and all of our aggressive groups and everything going down, all of this has occurred with the yields rising pretty rapidly. So we're seeing the yields go up. That means bond prices are going down. And during this period, stock prices have gone down. We're down for the year. So we're seeing inverse correlation between the yields and the S&P 500 on a weekly basis. And you can see this started maybe late summer of last year, rallied into the early part of the fourth quarter. And then really in November, when we saw a lot of the areas of the market top, a lot of the aggressive areas, we also saw this correlation top and start to move back down. So I would say at this point, yields are moving up for all of the wrong reasons, namely inflation. That's the big reason the Fed is talking about inflation. And the 10-year Treasury yield, 10-year Treasury investors are beginning now to price in some inflation. What's going to be very interesting, though, is next Tuesday, or this coming Tuesday, we have the March CPI report coming out. I believe, and we'll see what happens, I believe it could be the top of the core annual CPI rate. I think with this reading coming up, this might be as high as it gets. Now, if we really do have inflation problems, I'm going to be wrong and it'll keep going higher and we're going to have to continue to fight inflation. But I think a lot of it's pandemic related, supply chain issues. I think if we are looking at the economy slowing down and demand starts to slow down, all those supply chain issues will begin to take care of themselves because demand will slow down. And if that's the case, where's the inflation come from if you look at it from an economics 101 standpoint? If demand slows, that's part of the problem right now. We got two parts of the problem. We've had the post-pandemic demand, which has been soaring, and then we've had the post-pandemic supply issues, supply chain issues. So we haven't been able to keep up, and we're doing everything we can to try and catch up. Well, what if the demand starts to come down? All of a sudden, it'll make it easier for supply to catch up. And then what happens? I mean, economics 101 taught me that at that point, inflation slows. So watch Tuesday. I expect the number to go up. Headlines will be crazy. We've already got the 10-year treasury yield soaring. So, I wouldn't be surprised if the market just, has this ugly move between now and Tuesday. And then all of a sudden the bad news hits and everybody then says, throws in the towel and the market rebounds from there. That would be one possible scenario. I wouldn't be at all shocked to see. Who knows, right? We'll see. Anyway, let's keep moving because we got some other things to talk about here before we wrap up in 10 minutes. S&P 500 moving down. We're talking about, maybe looks like at the open, maybe down 40 points or so. That would take us from yesterday down to about 44.85. The 20-day EMA is at 44.83, 44.84. So it looks like we could open on the 20-day. So this is the dilemma. And this is, I wish I had the answer for everybody. I don't. We're pulling back in an uptrend to the 20-day EMA. In a market that I'm really bullish about, I'd be buying with both fists. I would love this gap down today testing the 20-day. But in this market, we could have had a false breakout. Maybe that's the false breakout before we go back down and test this new low. We still have some sentiment issues that potentially we could work through or need to work through over the summer. It's not an easy call to buy on the 20-day. I would say this, if you're looking at this as a bullish move and you decide, okay, I'm buying the spider on the 20-day test, I wouldn't blame you. Normally, I would say that is the right move. When the PPO is positive, we're trading above the 20, which is above the 50, and we test the 20 normally, I would jump right in there with you. I'm not going to do it today. Like I said, I'm being very cautious about the market. I would just say this, if you buy on the 20-day test and it doesn't work, get out. Because moving averages work in a trending market. Moving averages do not work at all during a consolidation period. It's like they're not even there. So if we go back down below the 20-day moving average, I would forget about this being an uptrend, at least in the short term, at least right now. If we close below the 20-day moving averages, I would be treating this at best as sideways consolidation, which would be okay, actually. This is what we did back in 2015, 2016. We had a big drop, had a big rally, had another big drop, but we held on to the prior low, had another big rally, and then had a final drop at the beginning of 2016 that took out the prior lows barely and then rallied back off of that. Something like that developing throughout 2022 wouldn't shock me at all. I think it would be good for the market from a long-term bullish standpoint to have more consolidation. It'd be a better base to build off of, get rid of a lot of the weak hands, get stronger investors in. And then at that point, I think the market would be ready to launch later this year. Fourth quarter of this year, I believe, is going to be very strong. And I think the weaker it is until then, the stronger it'll be in the fourth quarter. So I think we just have to deal with some things. But watch that 20-day. I think that's going to be really important. NASDAQ. Now, the NASDAQ right now is looking to open down about 1.5%, which would be about 210, 220 points on the NASDAQ 100. If that's the case, if let's say we go down about 200, 220, that would take us down to 14,600. The 20-day is at 14,590. So just like the S&P 500, when we open today, we're going to be opening above a key moving average, which is above the 50-day moving average with a PPO that's strong. This is going to be a test for the NASDAQ, for the S&P. Maybe we bounce short term just for the day, maybe into tomorrow or whatever, and then maybe we go back down again. Maybe this would be the bullish case. We bounce off the 20-day and we go break to new highs. It would be hard to ignore that kind of bullish behavior because when you get a PPO that's above the center line, price action above the 20, above the 50, if you test the 20 and go back and set a new high, I know we got a lot of bad news out there, but I watch the tacticals. I don't go to the media looking for my entry points. All right. By the time the media tells you it's time to enter, you're in big trouble. Market's going to be gone, long gone by then. The media is going to continue to give you all the bad news, even while the market sets new all-time highs. So pay no attention to the media while you're trying to make investment decisions. Look at the charts. Semiconductors. This is one that bothers me. I mentioned this in our daily market report to members yesterday. That's a big down day. We lost the 20. We lost the 50. We closed at the lowest level we've seen about the last 3 weeks. And it's been a rough 5 days for semiconductors. This is one of the most influential growth areas in the market. When this group is underperforming, I take notice. It's hard for the market to go up when semiconductors are getting hit so hard. So can we rally back? I mean, if the market's down, semiconductors are going to probably be down pretty good at the open again today. Can we print some sort of a reversing candle today? If not, we're going to bring in a major support level back into play, which is down around 7,200. We have had multiple tests going back the last 6 to 8 months at about that 7,200 level. So if we open down, 1.5% here, we're talking, well, 8,000 would be what, 120 points. So we'd be looking at 78.40 on the open. It's not looking very good for the semiconductors right now, and that does bother me. Here are the 2 charts that bother me probably the most, though. The S&P 500 rallying here, pulling back, and on this rally right here, we're way below the prior highs. But on a relative basis, consumer staples set a new high in March. Healthcare on a relative basis set a new high in March. Real estate's on the verge of setting a new relative high right now. And utilities just soared in late February, early March to set a new high, and they're coming back up again. All these are defensive groups. Since the market topped, and even before the market topped, even back in November and December, this is when we started seeing consumer staples rally, from back in November on a relative basis. Same goes for healthcare. Real estate's been more up and down, but from where it was in November, we're much higher. Utilities, November, low, much higher. So you see what's happening is defensive groups led during the final stage of the rally, which I always talk about. That's one of the last things that happens because Wall Street moves into the defensive groups. So you're still seeing a lot of buying in the market. It's Wall Street pouring into defensive stocks. That's what gives us that final little lift, that gives us that last ray of hope. Of course, if all you do is look at the S&P 500, you don't know that. You just see it's going to a new high. Got to look at these under the surface signals. The other chart is the other part of the market, the aggressive groups. So here's our top. You can see technology on a relative basis topped earlier in December. Discretionary stocks double topped on a relative basis in November. Communication services topped all the way back at the beginning of September. Industrial saw a little bit of strength earlier in the year, but look at them rolling back over again. There's that transport I'm talking about. Financials. My gosh, the yields are going crazy. What's going on with financials? Why aren't they doing well? Because rates are going up for the wrong reason. If rates are going up because of a stronger economy, I can promise you this would be the leading group, or one of the leading groups. Since the end of February 24th, remember the market bottomed? Since that time, what's Wall Street doing? Completely getting out of financials. Why? Rates are going up. That should be good for financials. This is where the charts tell us a story. You got to look at all the charts. You can't just look at the S&P 500. Can't just look at, one area of the market. You need to look at these intermarket relationships. These 2 charts right here will tell you most of what you need to know about the stock market at any given point in time. What are defensive groups doing on a relative basis? When the market's going down, it's okay for defense to lead. That's normal. But when the market's going up, you don't want defensive groups leading. And even with the rally, I mean, look at the communication services. We had one little blip there with Elon Musk coming out talking about, their stake in Twitter, Tesla's stake in Twitter. That saw a little bounce. Other than that, I mean, we've been almost straight down. This maybe came in with Google's earnings somewhere right in here. Google probably reported right toward the end of January, early February. So it was right about in this area. That gave the communication services a lift temporarily. But we got problems here in the market still. It's just a question of whether or not we go, it's a question of whether or not we go sideways or whether we have another leg down. That to me is probably the biggest issue. All right, it's 9:30. Just want to give you a couple of stocks here reporting earnings yesterday. One was Nova Gold NG. Let's get an update, see if we can get the, it's not showing at this point. But let's pull up SGH. That was another one, Smart Global. This is a semiconductor. It is up 80 cents today to 23.97, but it's in a downtrend. It already got up to 24.64, which is about the area of the last breakdown. This one's probably going to have some problems getting through 24.5 to 25. We'll see. But if we fail and go right back down to new lows, that's not going to be a good look on SGH. This morning, Simply Good Foods. Yes, what is that? SMPL. Simply Good Foods Company was down a little bit at the open. You can see actually this one I wouldn't be surprised to see rally back just because of where it's located, the group it's in. It also beat on estimates 36 cents versus 28 cents. So this one going down to test the 20-day, I wouldn't be surprised to see a rally here. Tilray, one of those wacky tobacco stocks, TLRY, they did come in with profitable operations last quarter. They had a profit of 4 cents. They were expected to lose 8 cents. And this is a heavily shorted stock. So this will be an interesting stock to see if we can get through the prior high, that last gap up. If we do, I mean, you can see this is starting to trend higher, move up, test the 20. We're starting to move up. The confirmation, though, would be a breakout above that prior high. So let's see if we can get that. All right, the three you must see. Let's see. No, I don't want to do the QQQ. Let's do one of the companies that reported earnings, I think day before yesterday, might have been yesterday morning. But this was Acuity Brands. And you can see the big move down, very heavy volume, trying to hold on to this support level. Got major 52-week lows coming up from July of last year, around 160. We're currently at 168.61. So I think we got a little bit of downside action there to possibly test that low, and then we'll see what happens from there. GameStop came out. They announced their stock split. Stock's been going down. It's going to split on its own the way it's going. After the stock split announcement, it went back up, opened just below that prior close. To me, that's a warning sign. And since then, we have gone straight down from 190 down to 150 in just 3 trading days. Looks like we got a 20-day test coming up. That's down at 142. That's what I'd be looking for there. The last one's a company I really like, Datadog, but I didn't like yesterday's candle, and now it's gapping down a little bit today. This is actually one of our portfolio stocks. I love the company long-term. I just didn't like that move yesterday, and we're starting to see that again from some of these growth stocks. So I'd be careful if I was in a growth stocks and I wrote it down and then it wrote it back up above key moving averages. If it takes another move back below moving averages and you're more short-term oriented, I personally would be out of them. I mean, just because I love the stock doesn't mean that I would be owning it, if it's not looking good technically. Our portfolios, we own no matter what. So I want to differentiate. Anything we put in our portfolios, we hold 90 days. And yes, it hurts sometimes, but we want to be very, what's the right word? Well, we want to be simplistic. Transparent. That's the word I was looking for. We want to be very transparent. The problem is with portfolios and all, when we start doing too much trading, if we started trading in those portfolios, that's not appealing to long-term investors. And that's really what we put these portfolios together for, is for long-term investors. If you start saying, well, we're getting out of Datadog because it went below the 20-day, what happens if 2 days later it's back up above the 20-day? We're getting back in? Well, I could understand as a long-term investor, that would drive me nuts. Wait a minute. I just sold them 2 days ago. Now you want me buying it again? That's the difference between portfolios and, owning the portfolios for a quarter and trading them. And everybody has to make their own call. I'm a trader. So I like stocks that are showing strong momentum. I don't want to hold a stock that's breaking down below key moving averages. That's just me. Everybody's different. Everybody has different trading concepts. Anyway, right now the stock's down another 4% or so, down $6. Quick update on the market, then we'll wrap this thing up. Right now we're showing the Dow Jones down 291 points, S&P 500 down 48, NASDAQ down 225. So on all three of these, we are now at or just below the 20-day EMAs. It really does matter where we go today from here. If we sell off from here, I think that's a bad look on the chart for the equities. If we can rally from here, then we got the potential successful 20-day test. Which way do we go? I don't know. Anyway, that's it for me. Listen, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. So at 9 a.m. tomorrow, Stock Charts TV, just click on that. And you can listen to the next episode of Trading Places Live. Have a great day, everybody. Happy trading.